portfolio manager for the Schroders Australian High Yielding Credit Fund, or 𝗲𝗲, the active ETF, which is listed on 𝗲𝘂. The fund is currently delivering a one-year return, gross return of 7.48%, yielding roughly around 5.8 to 5.9%, with a coupon on the fund of just over 6%. So let's step in for a quick market review of what's been happening over the last 3 months since we last spoke. Well, it's been quite a volatile time, that's for sure. But even though we've seen cash rates falling this year, Australian credit yields remain pretty solid. And even if you look above Australian franked equities or global equities, yields are quite significant. If you look here on the chart on the right-hand side, you can see how the Australian Credit Fund is stacking up against global equities, Australian equities, and Australian investment grade credit. Spreads have obviously been quite volatile, and we've seen that given since Liberation Day with the Trump activity. And so you can actually see that on the left-hand side of this chart here, that for US investment grade credit and for Australian investment grade credit, spreads did widen around that Liberation Day period and have retraced somewhat. But what's actually pretty interesting is that investment grade credit hasn't retraced as much as US IG, and we're actually higher rated than the US investment grade universe as well. So therefore, what that's signaling at the moment is that Australian credit is still looking quite cheap, both from an investment grade perspective and a high yield perspective. And just as a reminder, Australia doesn't really have a high yield market or a sub-debt market as you would experience in the US and Europe. Our higher yielding universe is really limited to the subordinated credit universe, which much of it is actually investment grade rated anyway. But you can actually see here from the chart on the right hand side that spreads on very high quality Australian tier 2 major bank paper is actually looking still very, very attractive. So turning now to fund performance, you can see on the one-year number, the fund is delivering gross performance of 7.48% or net performance against the RBA cash rate of 3.28%. This is quite outstanding considering we've had so much volatility in spreads since the Liberation Day activity from Trump. I also wanted to take the opportunity to highlight on the left-hand side, I'm showing here the Sharpe ratios of Australian equities, the S&P 300, the sole active Australian Hybrid Securities Index, and also the Schroders Australian High Yielding Credit Fund. What the Sharpe ratio is telling you is per unit of return, what risk you are taking relatively. You can actually see that the Schroders High Yielding Credit Fund is actually performing quite outstandingly from a Sharpe ratio perspective. So essentially, you're getting paid more to take less risk within the Australian credit universe at the moment. What I'd also like to highlight is against bank hybrids, which is something we're all talking about at the moment. The Australian Credit Fund continues to perform significantly better than the hybrid universe. And it's interesting because the fund itself is far more diversified and much higher quality. It's something that investors really should be thinking about as those bank hybrids start to roll off. Okay, so let's have a look at the market outlook. The main changes to our view have been our preference to hold longer dated tier 2 paper. We've certainly seen more value in the longer dated Kanga issuances. However, with rates declining, we also see a more positive environment for the Australian REITs to outperform. We continue to favour Australian dollar bonds above Euro and US dollar denominated bonds. This month, we've had issuance from Lloyds, NatWest and ING, as well as CBA and BPCE issuing Tier 2 bonds to the market. In the corporate space, we've had Volkswagen and John Deere both doing senior issuances, whilst NextEra, excitingly, did a 𝗝𝘂 corporate hybrid, so continuing to grow that market, which is great. NextEra is a US energy company. So whilst supply is tracking well, despite the volatility we've had over the last 3 months, we do expect major bank sub-debt issuance to slow, given that they're well ahead of their funding requirements for 2026. And however, this might be offset by insurance company issuance in Tier 2 or Tier 1. Also, 𝗝𝘂 banks may continue to issue Tier 2 for into the rest of this year, but also the mutual banks. And over the last quarter, we had Heritage People's Choice and MyState also doing Tier 2 issuances into the market. So speaking of Tier 2, you can see how strongly the Tier 2 supply this year has been tracking against 2024, with a quarter of the issuance coming from the insurance companies, the 𝗝𝘂 banks, and the regional/the mutual banks. So we really consider that part of the market a place that's growing, despite less issuance coming through from the major banks currently. The other point I want to highlight is this growth in the Australian corporate hybrid market, which is really exciting for us. You can see these 6 deals on the screen have been issued since the beginning of the year. They add great yield to the portfolio, noting that these companies are actually all investment grade. And so the subordinated debt remains investment grade in all of these cases. It's very, very high quality, but delivering very high yields as well. They're a great opportunity for institutional investors to add yield to the portfolio without compromising quality. Okay, so finally, fund positioning. Where are we at and what are we doing? Well, since we last spoke, we've increased diversification in the portfolio. So what do I mean by that? We've actually increased the number of sectors we're holding. So we've added some consumer staples and we've also added some agency bonds as well, which are a lot higher quality. We've been reducing some of our bank sub-debt exposure, but again, we're still thinking about cautiously adding risk where it makes sense. And where we've been doing that is within that corporate hybrid bucket that I was talking to you about before. As you can see, our currency exposure remains predominantly in Aussie dollars, and we'll continue to take that stance, I think, whilst we continue to see so much volatility in the US in particular. We're evenly split around junior, subordinated, and senior bonds at the moment, with our main focus in the subordinated space, the Tier 2 area. We're heavily weighted again to the 𝗝𝘂𝐵s, and the current portfolio rating is 𝗝𝘂𝐵+.